I'm going to explain why buying a house with high interest rates don't matter. I'm also going to show you a simple tool that will help you figure out the maximum monthly payment you can afford. To understand why high interest rates don't matter, in my opinion, you have to understand that prices are determined by supply and demand. When there's a lot of demand and not enough supply, that means there are a lot of people with the ability to pay who want something that's hard to get. And that means prices will be high. When there is a lot of supply and low demand, that just means there are more things than there are people who can afford to buy it. That means prices for that thing will be low. But that also means prices can affect demand. For example, when something is expensive, that means there are fewer people both willing and able to buy it. Like if I were to charge $100 to watch my videos, no one would watch them. Truth is, it's free and I'm still struggling to get views. That brings me to my next point. The cheaper something is, the more people are willing to take a chance on it. So again, because my videos are free, as pitiful as the view count is, that's still more than I would get if I were to charge for them. What exactly does this have to do with interest rates? Interest is the cost of borrowing money. When a bank lends you money, they charge you for that service, and interest is that charge. And when interest rates are low, the cost of borrowing money is cheaper. But when interest rates are high, the cost of borrowing money is more expensive. So how do you think that influences people looking to borrow money to buy a home? That's right. When interest rates are low, there are more people willing to borrow money to buy a home. And when interest rates are high, there are fewer people willing to borrow money to buy a home. But again, supply and demand. High demand and low supply equals high prices. Low demand and high supply equals lower prices. So when more people are borrowing money to buy a house, that means demand for houses is high, which means house prices go up. And when fewer people are willing to borrow money to buy a house, that means demand for houses is low, which means house prices go down. And if we lived in a perfect world, then we'd be able to predict when interest rates fall X%, then house prices go up X%. And vice versa. But we don't live in a perfect world, and we have other economic factors to deal with, like employment rates, inflation, etc. So it's impossible to predict any of these things with any degree of certainty. However, looking back into the past, experts far smarter than me have come up with an average. And by average, I mean that in some periods of our past, a change in interest rates results in a change in house prices more than this number. And in other periods of our past, a change in interest rates resulted in a change in house prices less than this number. And that number is 1 to 10. That means for every 1% change in interest rate, there's a 10% change in house prices on average. So if interest rates go up 1%, house prices go down 10% because fewer people are willing to borrow money to buy a house. And if interest rates go down 1%, the price to borrow money is cheaper. So house prices go up 10% because more people are willing to borrow cheap money to buy a house. Of course, there's a delay between the change in interest rates and house prices. Sometimes interest rates can climb 3 to 4% before we see a change in house prices. And inflation and local market conditions can also prevent house prices from coming down. For example, if inflation is 8% per year, that means something that costs $1 million will now cost $1,080,000. But if interest rates go up 1% and that pushes the price down 10%, the new price of the house would be $972,000. Only a 2.8% drop in price. And if there's still an outsized demand for housing because new constructions haven't kept up with the increase in population in a local area, then you could actually see a slight increase in house prices despite interest rates going up. So what's a person to do to ensure they get the best deal possible? I can't speak to your specific situation. I can only speak about what I would do. And that would be ignore interest rates completely. I get it. The less money that you spend on your mortgage payments, the more money that you have for health care.
Bunch of hookers and cocaine.
Travel. But that assumes you have some control over interest rates. And you don't. Are you really going to feel better when you buy a house at 4% interest and then the interest rate drops to 1%? There's always going to be a better rate than what you're currently paying. The only thing you can really decide is if you can afford those monthly payments or not. For example, in 2020 when interest rates were low, this house cost $1.1 million. Today, it's $950,000. But if you look at a mortgage calculator, you can see that the monthly payment doesn't change all that much, despite interest rates increasing dramatically.
Conventional wisdom would have you pay $150,000 more for the same house just because interest rates were lower. And that's ignoring the fact that when house prices are higher, so is your down payment.
And if it was me and I could afford those monthly payments, I'd buy it. 1, because over a long enough period of time, house prices historically only ever go up, increasing your equity. And 2, if interest rates change For example, if interest rates go down, I can always refinance to either get a rate and term changed to lower my monthly payment or cash out that equity. On the other hand, if interest rates increase, I'll only be kicking myself for not buying it sooner when interest rates were relatively low.
So the real question to me isn't interest rates, but monthly payments.
Just how much monthly payments can you afford? I created a free calculator to help you figure that out. Let's say Bob and his wife earned $100,000 in 2021, $125,000 in 2022, and $150,000 in 2023. They also have $700 a month in car payments and $2,000 a month in credit card payments. Neither went to college, so they don't have any student loan payments, and neither has been married before, so they don't have any child support or alimony payments. And things like food, gas, cell phone, internet, entertainment aren't considered fixed costs. You can always eat less, use public transportation, and go without Netflix. But if you owe money on your car, student loans, or alimony, you had to pay that no matter what. Front-end ratio is what their housing costs would be as a percentage of their income, and their back-end ratio is what their total debts are as a percentage of their income. And it's normal for the front-end and back-end ratios to be different. The lender will always choose the lower number to calculate the maximum loan size you qualify for. And this is to ensure that you can afford the monthly payments. Different loan types have different maximums for the front-end and back-end ratios. Interest rates currently vary between 6.5 and 7%. So let's say Bob gets an interest rate of 6.5% and he puts down 3.5%. The bigger your down payment, the cheaper your house. So if you put $100,000 down and it represents 10%, that means the most expensive house you can buy is $1 million. But if you put down the same $100,000 and it's 3.5% of the home price, that means that house costs $2.8 million. So the lower the down payment, the more expensive the house. The most expensive house he can buy is $281,000 with an FHA loan. And the benefit of an FHA loan is that you can qualify for higher loan amounts because their debt to ratio thresholds are higher. Why do you need to enter all that information? This calculator calculates your debt to income ratio. The less debt you have, the smaller your debt to income ratio is, which means your monthly payments can be higher, which means that you can borrow more money, which means you can buy a more expensive house. In Bob's case, if he were to pay down enough of his credit card debt to get to $700 a month in monthly credit card payments, his max house price goes up to almost $500,000. Using this calculator, you can see the maximum monthly payment you can afford and still get a qualified mortgage. What is a qualified mortgage? That's another video. But in short, a qualified mortgage is a loan that meets certain conditions that the US government is willing to buy from your lender. Any loan that doesn't meet these conditions, the US government will not buy from your lender. A disclaimer. Just because this tool says you qualify doesn't mean you officially qualify. You still have to provide evidence such as pay stubs, tax returns, bank statements, and a full credit history. And for a lender to qualify you, they have to know what home you intend to buy so they can calculate the other obligatory costs, like property taxes and home insurance. But this is a good tool to get a rough number in your head. The other thing is, this is only for qualified mortgages for buyers who plan to live in the home they are buying. So if you're an investor looking for rental properties, this calculator doesn't work for you. But if you're looking for a home to live in, go to this website and follow the instructions. And if you find the amount you qualify for doesn't cover the home you want to buy, there's still other solutions like private money lenders. The point is, in order to qualify for a loan, you need to be able to prove you can afford the monthly payment. And this tool helps you see what size loan you qualify for. So feel free to play with this and figure out your maximum monthly payment based on the amount you earn and your fixed monthly costs.